Hi folks, Chuck Gibson from Financial Perspectives in our new office in San Ramon, California with December 2016's Charts on the Move. In this video, I'll be doing a quick reflective look back at some charts that occurred last year, one that I am labeling the year that no one listened. Before I start though, I want to wish everyone a very happy and prosperous new year. 2016 kicked off with a bang as U.S. stock markets put in the worst opening week in history, down 6% for the S&P 500 and 7.3% in the Nasdaq in 5 short trading days. By January 11th, stocks continued their fall and RBS had seen enough. They advised, sell everything except high-quality bonds and stay short commodities, especially oil. Every major media outlet ran with the call, adding to investor anxiety. It's important to remember, though, it's their job to entertain and it's your job to ignore. On January 20th, every global equity index was down year to date, below their 200-day moving average and at least 10% off their 52-week high. This was the first time real fear had returned to the market since 2011. Pundit after pundit issued warnings from emerging market collapse to junk bond implosion. CNBC paraded out commodity king Dennis Gartman, who put his expertise on the line saying oil had peaked and we would never see $44 again in his lifetime. As you would expect, bullish sentiment took a swan dive and hit its lowest level in years, even below the levels created during the 2009 financial crisis. All but one of my indicators had turned to a sell signal warning the stock market bull market was over. While not ready to throw in the towel, I was leaning heavily to the downside. But as we know, fear in extremes can be a good thing and potential contrary indicator, and it turned out this time was no different. By mid-February, the S&P 500 formed a bullish divergent oversold low, telling market participants the end of the sell-off was right around the corner. The only question to consider was the forthcoming rally to be a counter-trend bounce and eventually continue its sell-off? Or would it eventually push higher, breaking out to all-time highs, proving the January-February decline was just a minor road bump within the context of a longer-term bull market? It seems so easy now to see the answer as we look into our rearview mirrors. But at potential turning points, which this was, the only way to know for sure is to wait for the market to prove her intentions. As such, unless you're gambling, there's no reason to press your foot on the accelerator and increase your portfolio risk during times like these. Come mid-April, the S&P 500 would hit yearly highs. Only 2 months prior, it seemed as if the world was coming to an end. Those that have been involved with the market long enough know that this is the nature of the market, and it is the ultimate test to one's emotions. Not to be outdone, with stocks taking center stage, oil gave them a run for their money, following a very similar path, but on steroids, as it almost doubled its price in 4 short months from the February low. So much for Dennis Gartman's call for ongoing low oil prices during his lifetime, huh? With no central bank fears to rattle the markets, they continued to rally ever so slightly into mid-year until all eyes turned to England and its vote to exit the EU. Up until the day before the vote, the 2 major polls had the Remain ahead by 52 to 48 and 54 to 46 vote. Once the pollsters were proven wrong, market pundits were calling for the death of England's economy and their stock market to crash as they voted to leave. And crash it did. Well, for about 2 hours. It fell and then it reversed, as you can see in my next chart. In the meantime, the 30-year U.S. Treasury bond yield hit all-time lows in early July. Bids were coming in around 2.16%. Soon thereafter, financial experts jumped on the falling rate bandwagon, predicting a plunge in the 10-year Treasury yield to 1% by the end of the year, and a final bottom just slightly higher than 0.25% into the future. Well, as you can see in my next chart, plunge they didn't. Something very strange happened on July 8th. The 30-year Treasury yield hit an all-time low, while the S&P 500 hit an all-time high. This was an unusual development to say the least. Investors were behaving in a risk-on and risk-off fashion at the very same time. It seemed the markets were confused and looking for a catalyst. While it took almost 4 months, it turned out the U.S. elections were exactly the catalyst the doctor ordered. In the week prior to the presidential election, the S&P 500 completed its 3rd correction of the year, the 21st since March 2009. A modest 5% pullback from its all-time high in August. After having subsided from its peak earlier in the year, fear began to once again rise. It reached a crescendo as election night progressed and it became clear Trump was going to win. Once it was confirmed, panic set in. Few saw Mr. Trump being elected. The New York Times had an 85% chance of Hillary winning. Nate Silver of 538 said there's a wide range of outcomes, but most of them come up Clinton. And anyone who did saw markets crashing as a result. In fact, MarketWatch wrote that election of Donald Trump will likely cause the stock market to crash and plunge the world into recession. And crash they did, but only for a few hours. S&P 500 overnight futures were limit down on election night, while the Dow was down more than 800 points. Stock markets around the world traded lower, as did the US dollar and crude oil. The flight to safety trade was on, with gold up more than 4% and treasury yields plummeted. On the morning after, financial news outlets were on red alert, marching experts in with sage advice in an attempt to capitalize on fear and raising their ratings. To help distressed investors. If you didn't get to the sidelines before the vote, get to it now. I don't think we're going to get a post-Brexit bounce. I think this is something far more serious and far more onerous, one talking head professional bemoaned. We all know what happened next. By the open the next morning, the S&P 500 had recovered all of its overnight losses. By the end of the next trading day on November 9th, everything had reversed course from its initial post-election reaction. Stocks had rallied. Gold was lower. Bond yields moved higher, and the U.S. dollar index surged. The Dow hit a new all-time high that very day. What has since followed is a massive rally in the dollar, U.S. Treasury yield, and risk-on assets, especially benefiting financials, industrials, and small-cap stocks. No matter which way you turned, 2016 turned out to befuddle market pundits. This is why it's good to know the markets are nothing more than a giant feedback loop. A thermometer reading of social mood under which investors and, by extension, society are operating. And its disposition can change on a dime, like my bipolar kitten. Looking ahead, no one knows. But we do know that after 8 consecutive up years on the S&P 500 and NASDAQ, one has to wonder if there's enough gas in the tank to tie the all-time historical record of 9, which, by the way, occurred from 1991 through 1999. By making 2017 another winner. Or whether this aging bull needs to rest. Either way, it's likely we're in for some very interesting times. Well, that's it for this month. As always, appreciate your time and your attention. I hope you found this video informative and helpful. If you have any special requests for next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening. Until next month, this has been Chuck Gibson from Financial Perspective with December 2016's Charts on the Move.